It's Tuesday, November the 12th. I'm Jamie McDonald, and this is Before and After from Refinitiv. This week, in the Before segment of the show, we're looking at how to play the upcoming US CPI and Walmart's earnings call. In the After segment, we look back at what we can learn from the Japanese machine orders report. Let's jump right in. With markets fixated on deflation and disinflation, there are so many data points to study. Factory inflation, employment costs, and average hourly earnings, just to name a few. But it is US CPI that households really care about. The Consumer Price Index imagines a basket of hypothetical goods and services. It arrives at a weighted average of the price changes. Worldwide, many of the inflation indicators are trending down. Some indicators, such as PPI, are falling below zero in areas such as China and Europe. Long-term inflation expectations may have bounced, but nowhere near enough to move them from their all-time lows. US core CPI, however, is at the 6-year highs of 2.4%. An unexpected move higher could fuel yet another jump in risk assets as the market is forced to reprice for growth. The markets appear to have been caught short by the reflation talk over the last few weeks, with bond yields rising and equity markets surging. Jerome Powell said explicitly that inflation would have to rise before the Fed takes notice. Quoting him from the last Fed meeting, "I think we would need to see a really significant move up in inflation that's persistent before we even consider raising rates to address inflation concerns." It looks like even if core CPI breaks above the 6-year highs, the Fed is not going to flinch. They're going to let inflation run hot. If the market sensed that happening, we may have only seen the start of the shift to repricing for growth. On the other hand, this may dial back some expectation of central bank liquidity that this move in risk pricing has already implied. The equity markets may opt for a breather. They may have to temporarily set aside their love of liquidity because while the Fed will not act to stop inflation, they will also not be in any hurry to cut rates again anytime soon. If core CPI misses, well, then the broader concerns from earlier this year were not misplaced and will again be relying on the kindness of central bank liquidity. In terms of price action, our Refinitiv data show us that we should keep an eye on how the iShare Bond Fund ETF trades. The fund tracks the performance of Treasury Inflation Protection securities, commonly known as TIPS. So a big bump up in CPI would result in a higher TIP price, while other bond prices should be tumbling. An upside surprise in inflation would catch the market off guard, to say the least, but US core CPI is primed to catch investors on the wrong side. The other big upcoming announcement we want to look at this week is Walmart. Before the internet, people used to go to a store and buy things. In this Before segment, we have the brick and mortar behemoth that refuses to bow down to the online onslaught. With its share price near all-time highs, giving it a market cap in excess of $300 billion and a nosebleed PE of over 24 that you would commonly associate with a cyclical or tech stock rather than a grocery store, Walmart's daily volume averages in excess of $700 million and has a historical volatility that is close to 10. Because of all these factors, results day can be a great trading setup for both institutional and day traders alike. You could perhaps make the argument that it is just the usual suspects of cheap capital on the hunt for reliable revenue and dividends who are willing to pay a premium that keeps driving Walmart's share price higher. But this earnings report will be the real test. Walmart's PE is extremely stretched as the stock has rallied hard with no earnings growth and flatlined revenues. The last time Walmart's PE was above 24, a 25% correction ensued in the following 6 months. That should sound some alarms. At 24.43 PE, Walmart is one of these price-to-perfection names. It leaves little room for error and they can't afford a hiccup in operating costs. If revenue guidance comes out weaker than expected, then look out. Walmart is expected to earn $1.10 a share, and all eyes will be on whether they can maintain that e-commerce yearly growth of 35%. They have to take on Amazon at Amazon's game, focusing on the same one-day fulfillment initiative that Amazon has invested so heavily in. With the announcement of their earnings, there are more scenarios pointing towards the stock taking a breather on the downside than having a surge higher. If Walmart doesn't show store growth of 3.5% and we see operating margins continue to squeeze, perhaps due to trade wars, we should see some selling. Unless guidance is dampened greatly, the external factors that have guided Walmart's stock higher would remain in place. Our Refinitiv chart highlights the blinking warning light that the market is entering a near parabolic regime here at the end of the year. A mediocre result with bullish price action would be a very strong confirmation that the year-end flow is real and the so-called Santa rally is in the cards for the markets. Remember, this stock is one of the poster children for passive money. It will take a lot more than an earnings miss to turn those inflows around. Last episode, we discussed Japan and their role at the epicenter of the global manufacturing slowdown because of their industrial core and proximity to China. The previous revised reading for Japan's machinery orders fell to minus 14.5%, the lowest level since 2014, and was one of the data points hinting that a global manufacturing recession may be upon us. This month's release was therefore going to be a barometer not only for Japan, but the broader global manufacturing outlook. Well, the year-on-year figure had a healthy rebound to 5.1%, right back into the middle of the longer-term range. Not only is it a relief that Japan's manufacturing sector is not undergoing a massive deceleration, but it joins numerous other global data points such as US non-manufacturing ISM and the export component of the ISM manufacturing data in having a significant rebound from the previous month's release. Many of the concerns around a global recession will now be on the back burner, and the relief rally that we've seen in global markets over the last couple of months can remain on track. If there is any downside, it's that strong data will temper some of the optimism for more central bank accommodation, though this data set in isolation is not going to stop the Bank of Japan in its tracks. There you have it. Walmart earnings and US core CPI for the before, Japan's machine orders rebound for the after. I'm Jamie McDonald. This was Before and After. I am back on Friday. See you then.